The new development bank was established by BRICS nations and serves as an alternative funding source for the global south. The bank's executives are in the country for the G20 Leaders Summit led by Ashwani Muto, Director General of the Independent Evaluation Office at the new development bank.
We'll be assessing the cooperation, the partnership, the investments over the past decade. And this requires a very comprehensive evaluation of the entire portfolio of projects, more than $5 billion we're talking about. And this will entail site visits, interaction with government institutions, private sector, stakeholders, academia, and others.
The bank has renewed its commitment to the development of South Africa through a new signed memorandum of understanding that is expected to support various sectors and help boost the country's economy.
While NDB has funded a large part of projects in South Africa in energy, our general strategy does prioritize also investments in other areas, including infrastructure, transport, digital infrastructure, natural resources and environment sustainability. So there are also other sectors, and we have a new Director General of our regional office here in Johannesburg for the NDB, and now she's looking at scaling up the pipeline of projects and portfolios.
Over the past decade, global investment flows have undergone a noticeable shift as investors increasingly reassess traditional financial centers and explore emerging markets offering growth, scale, and strategic positioning. Among these emerging destinations, South Africa has drawn renewed attention as a regional and, in some sectors, global investment hub. While claims that Europe is panicking are rhetorical rather than literal, the changing patterns of capital movement reflect deeper structural challenges within European economies and evolving opportunities across Africa. South Africa's position at the southern tip of the African continent has long given it strategic importance. It serves as a gateway to sub-Saharan Africa, connecting global markets with one of the fastest-growing regions in terms of population and long-term consumption potential. Investors historically viewed South Africa as Africa's most sophisticated economy, with deep capital markets, advanced banking infrastructure, and strong legal frameworks relative to many peers. Despite periods of economic stagnation and political uncertainty, these foundational advantages never disappeared. In recent years, global investors have faced mounting challenges in Europe. Slower economic growth, aging populations, high energy costs, and persistent inflationary pressures have weighed on returns. Regulatory complexity and tightening environmental and social compliance requirements have further increased the cost of doing business. While Europe remains a major investment destination, particularly for stable returns, its appeal as a high-growth environment has diminished compared to emerging markets. At the same time, Africa's investment narrative has evolved. No longer framed solely as a frontier market, parts of the continent are increasingly recognized as strategic growth engines for energy, minerals, manufacturing, technology, and infrastructure. South Africa, with its established financial system and access to global capital markets, has positioned itself as a central platform through which international investors can engage the wider African economy. Foreign direct investment into South Africa has been driven by several sectors. Mining remains a cornerstone, with the country holding significant reserves of platinum, manganese, chromium, vanadium, and other critical minerals essential for renewable energy technologies and advanced manufacturing. As global demand for electric vehicles, batteries, and green infrastructure accelerates, these minerals have gained strategic importance, attracting long-term capital from multinational firms and sovereign investors. Energy investment has also played a crucial role. South Africa's transition away from coal-dominated power generation has opened opportunities in renewable energy, particularly wind and solar. Government-backed procurement programs have drawn billions of dollars in commitments from international energy companies seeking exposure to Africa's clean energy expansion. These projects not only promise returns but also align with global decarbonization goals, making them attractive to institutional investors. Beyond traditional sectors, South Africa's technology and financial services ecosystems have gained international recognition. Johannesburg and Cape Town have emerged as innovation hubs, hosting fintech, e-commerce, and software startups serving both domestic and continental markets. Venture capital inflows into South African tech firms have grown steadily, reflecting confidence in the country's talent pool, regulatory environment, and scalability. The strength of South Africa's financial markets remains a critical differentiator. The Johannesburg Stock Exchange is the largest and most liquid exchange in Africa, providing investors with access to a wide range of listed companies across sectors. The country's banking system is regarded as well-capitalized and well-regulated, offering stability often lacking in emerging markets. These features reduce risk for international investors seeking African exposure without sacrificing institutional safeguards. Europe's relative decline in attracting new growth-focused investment has multiple causes. High interest rates implemented to control inflation have tightened financial conditions, reducing appetite for risk. Energy price volatility following geopolitical tensions has eroded industrial competitiveness in several European countries. Combined with slower productivity growth, these factors have led some investors to diversify away from Europe in search of higher returns elsewhere. This diversification does not imply abandonment. Europe continues to attract capital for infrastructure, real estate, and defensive assets. However, the incremental growth capital that once flowed predominantly into European markets is increasingly being allocated to regions offering demographic expansion and resource-driven growth. South Africa's role as a stable entry point into Africa has benefited from this reallocation. Geopolitically, South Africa's non-aligned foreign policy has also influenced investment perceptions. By maintaining economic relationships with Western nations, China, Russia, and other emerging powers, South Africa presents itself as a neutral platform for global business. This positioning reduces geopolitical risk for investors wary of being caught between competing blocs. Trade dynamics further reinforce South Africa's appeal. The African Continental Free Trade Area promises to create one of the world's largest integrated markets by population. While implementation remains uneven, investors view South Africa as a likely beneficiary due to its infrastructure, logistics capacity, and manufacturing base. Companies investing in South Africa gain potential access to a vast regional market as trade barriers gradually decline. Critics point out that South Africa faces significant domestic challenges, including high unemployment, inequality, and infrastructure constraints, particularly in electricity supply. These issues present real risks and have tempered investor enthusiasm in the past. However, recent reforms aimed at improving energy availability, logistics efficiency, and regulatory clarity have signaled renewed commitment to economic stabilization. From a European perspective, the rise of South Africa as an investment destination underscores broader competitive pressures. European economies must balance social protections and environmental goals with the need to remain attractive to capital. As investors gain confidence in emerging markets with improving governance and strong resource positions, Europe's comparative advantage narrows. Global capital is inherently mobile. It flows toward regions offering the best combination of stability, growth potential, and strategic relevance. South Africa's ability to attract investment does not depend on Europe's decline alone, but on its own efforts to reform, diversify, and leverage its unique strengths. The perception that Europe is panicking reflects anxiety over losing influence rather than immediate financial distress. International institutions have noted Africa's increasing share of global investment flows, though from a low base. South Africa consistently ranks among the top recipients on the continent, reinforcing its status as a focal point for international capital. This trend is expected to continue as global demand for critical minerals, energy transition assets, and new consumer markets intensifies. For multinational corporations, investing in South Africa offers strategic optionality. It allows companies to hedge against stagnation in mature markets while positioning themselves for growth in emerging ones. This logic has driven renewed interest from firms across manufacturing, finance, technology, and energy. The narrative of a global investment shift also reflects changing investor psychology. Risk assessments increasingly incorporate long-term structural factors such as demographics, climate resilience, and supply chain security. Africa's young population and resource endowment stand in contrast to Europe's aging workforce and resource constraints. South Africa's challenge will be to sustain momentum. Attracting capital is only the first step. Converting investment into inclusive growth requires policy consistency, infrastructure development, and social stability. Failure to address these issues could reverse gains and reinforce skepticism. Nevertheless, the current trajectory suggests that South Africa is regaining its reputation as a leading investment destination. While it may not yet rival traditional global financial capitals in scale, its strategic role within Africa gives it outsized importance in global investment strategies. Europe's response will shape the long-term outcome. By accelerating innovation, investing in competitiveness, and strengthening economic integration, European economies can retain relevance in a multipolar investment landscape. The rise of South Africa does not necessarily signal Europe's decline, but it does illustrate a more balanced global distribution of capital. The global investment map is becoming less concentrated. Power is diffusing across regions, and capital is following opportunity rather than tradition. South Africa's emergence as a key destination reflects this transformation, highlighting how emerging markets can redefine their role in the global economy. In this context, headlines about panic and shock capture attention, but the underlying story is one of gradual, structural change. Investors are recalibrating, not abandoning. South Africa as ascent represents an expansion of global investment options rather than a zero-sum loss for Europe. As capital continues to move, the countries best positioned to benefit will be those that combine stability with growth potential. South Africa's current trajectory suggests it aims to be among them, shaping a future where global investment is more evenly distributed across continents.
You've been watching Echoes of Africa, where every story carries the sound of tomorrow. If this moved you, subscribe now, like, and share so Africa's voice never fades into silence.